In the time it takes you to blink, fortunes are made, empires are toppled. And the retirement savings of millions are decided by an algorithm thousands of miles away. We often look at the stock market as just a chaotic sea of red and green numbers flashing on a screen. A casino for the wealthy, or a confusing puzzle for the rest of us. But look closer. Those numbers aren't just data. They are the pulse of human civilization. They represent the collective confidence, fear, and ambition of the entire world. Every single day, trillions of dollars change hands in a silent digital war. But have you ever stopped to ask what is actually happening when you click buy? Where does that money go? Why does a news headline in New York crash a market in Tokyo, whether you have $0 invested or $1 million? The stock market impacts the price of your groceries, the safety of your job, and the interest rate on your credit card. Today, we are going to strip away the jargon and the noise. We are going to travel from the dangerous docks of the 17th century to the fiber optic cables of modern Wall Street to decode the most powerful financial engine humanity has ever built. Welcome to the definitive guide on how the stock market actually works. To understand the modern stock exchange, you have to leave the skyscrapers behind and go back 400 years to the year 1602. Picture the docks of Amsterdam. The world was opening up, and trade was exploding. The Dutch East India Company wanted to send ships to the Spice Islands to bring back pepper, silk, and gold. But there was a problem. Sending a ship across the ocean was incredibly dangerous. Pirates, storms, and disease meant that if you funded a ship yourself and it sank, you lost everything. It was too much risk for one person. So, the Dutch came up with a revolutionary idea. Instead of one wealthy merchant funding one ship, what if 1,000 everyday citizens chipped in? In exchange for their money, they would receive a piece of paper proving they owned a fraction of the company and a right to a fraction of the profits. This was the birth of the share. And the location where these papers were bought and sold, the Amsterdam Stock Exchange, became the grandfather of Wall Street. This concept changed the world. It democratized wealth. It meant you didn't have to be a king to own a piece of an empire. You just needed capital. Fast forward to today, and while the wooden ships are gone, the core mechanism remains exactly the same. At its simplest level, the stock market is a marketplace, just like a supermarket or an auction house. But instead of selling apples or antiques, it sells ownership. When a private company, let's call it Teknova, wants to grow, it needs money to build factories or hire engineers. It has two choices. It can borrow money from a bank and pay interest, or it can sell pieces of itself to the public. When they choose the latter, they perform an initial public offering, or IPO. This is the primary market. It is the moment the company says, "Here is 30% of our business. Who wants to buy it?" Big banks and institutional investors buy these initial shares, giving Teknova the cash it needs. But here's where it gets interesting, and where most of us get involved. Once that IPO is done, the company steps back. The shares are now out in the wild. They begin trading on the secondary market, places like the New York Stock Exchange or the NASDAQ. When you buy a share of Apple or Tesla today, you aren't sending money to Apple or Tesla. You are buying that share from another investor who wants to sell it. The stock market is essentially a massive global matchmaker, connecting buyers and sellers. So, what moves the price? Why does a stock skyrocket or crash? It comes down to the oldest law in economics: supply and demand. Imagine a limited edition pair of sneakers. If everyone wants them, and there are only a few pairs, the price goes up. If the hype dies and nobody wants them, the price collapses. Stocks work the same way. If investors believe a company will make more money in the future, they rush to buy, and the price rises. If news breaks that the company is losing customers, people rush to sell, and the price falls. But who are these people buying and selling? This is where we need to distinguish between the players. There are the retail investors, that's you and me, trading on apps from our phones. We are the small fish. Then there are the institutional investors, pension funds, mutual funds, and banks. They are the whales. When they move, the ocean shakes. And finally, there are the market makers and high-frequency traders. These are sophisticated firms using supercomputers to buy and sell stocks in milliseconds, profiting off tiny price differences. In fact, nearly 80% of all daily trades aren't made by humans at all. but by algorithms reacting to news faster than you can read a headline. This brings us to the ecosystem of the market. You have the exchange, which is the venue, like the NYSE. You have the broker, which is your gateway app or bank that executes your trade. And watching over it all is the regulator, like the SEC in the United States, acting as the referee to prevent fraud and ensure fair play. But why does any of this matter to you if you don't trade? Because the stock market is the leading indicator of the economy's health. When markets are confident, businesses have access to cheap capital. They build new factories, they invent new technologies, and they hire more people. Your 401k, your pension, and even the stability of the bank where you keep your savings are often tied to the performance of these markets. When the market crashes, credit freezes, companies stop hiring, people lose jobs. The invisible lines on the chart have real-world consequences on your dinner table. However, we must address the dark side. The market is not a guaranteed money printer. It is driven by two primal human emotions, fear and greed. History is littered with crashes: 1929, 1987, the dot-com bubble of 2000, the financial crisis of 2008. These events usually happen when speculation takes over investing. Investing is buying a piece of a company because you believe in its long-term value. Speculating is gambling that the price will go up tomorrow just because everyone else is buying it. When the hype bubble bursts, reality set in, and billions of dollars in paper wealth can vanish overnight. It is vital to understand that the stock market is volatile in the short term, but historically, it has been an engine of growth in the long term. It rewards patience and punishes impulsiveness. It is a system designed to transfer money from the impatient to the patient. So, where does this leave us? We live in an era where access to the stock market is easier than ever before. You have the power to own a piece of the global economy in your pocket. But with that access comes a responsibility to educate yourself. The market is a tool. It can build generational wealth, fund the next medical breakthrough, and secure your retirement. Or, if treated like a casino, it can be a devastating trap. Understanding how this machine works, from the Dutch spice ships to the high-speed algorithms of today, is the first step in taking control of your financial future. The ticker tape never stops, and the world keeps turning. The question is, will you watch from the sidelines, or will you learn to navigate the waters? If you found value in this deep dive, consider subscribing and turning on notifications. We are building a community of thinkers who want to understand the economy, not just react to it. Leave a comment below on what financial topic we should decode next. Till then, stay curious and keep learning.